Good morning, John. Well, thank you for joining me. Got a few questions here. These things have just come up from clients over the past few weeks about investment markets and how things are responding and what sort of, well, in relation to what's happening in the world, really. So
Yeah, no, there's a lot going on. Nice to
there
see
is,
you.
there is. So, I guess, I suppose where the questions have really come from is how things behaved if we think of the calendar year of 2021. I mean, from pretty much everything went up from what we saw. And then sort of beginning of this year, things have sort of gone the other way. And I was with a client yesterday, in fact, and we could just see the performance on their individual performance graph, which shows growth, 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 and then just all that growth from last year has just dropped right back in the first 2-3 months of this year.
Yeah,
So obviously that clients don't like to see we know these declines are temporary, and over the long run it all works out, but it's still not pleasant to see these moments. So how are things? We've got the conflict in Ukraine. How's that impacting markets, and what can we do to protect and grow wealth during this time?
yeah. Okay. I mean, I understand sort of clients' reactions because clients always get these, particularly those that are new to investment. So some of these people, certainly in the last year or so, may not have experienced this sort of thing before, whereas those that are slightly longer in the tooth or more experienced have been through the peaks and troughs and kind of learned to look through them. But in terms of the market situation, if I'm going to take a step back actually to the end of 21,
Sure.
because the market started to turn south in December, before Ukraine and Russia became a major thing, and it was really all about the Fed, the US sort of central bank, and the direction of travel for interest rates and the outlook for growth and inflation. In sometime in mid-December it was, they kind of made clear that the direction of travel for interest rates was probably further and faster than markets had expected, i.e. interest rates going up quicker. So markets started adjusting to that. Powell, the chairman of the Fed, had a chance to sort of backtrack from that in early January in a press conference. And historically, he's always backtracked, always kept rates lower than people expected. But he didn't. He doubled down and said, no, rates are moving. Inflation is no longer transitory, and it's something we have to address. And so the market was really adjusting to that. We saw some big moves in fixed income, yields going up, so values going down. And that also had an impact on equity markets. And at the time, sort of through mid to late January, I remember seeing a survey about what are the biggest risks in markets at the moment. Number one was that the Fed go too far, put interest rates up too much, and damp down growth.
Right.
Number two was the Fed don't go far enough, and they don't put interest rates up far enough, and inflation gets too high. And number three was Ukraine, right? So then we get the sort of the double whammy of these already upset markets getting hit by, the invasion. I was going to say unexpected. It was unexpected. Certainly the timing of it, the speed of it, and everything. And so that clearly didn't help. But bizarrely enough, if you look at investment markets since the invasion, the US market is slightly up. So most of the damage in the US was done all around the interest rates and the inflation outlook. European markets, obviously because of their proximity to the conflict, did react worse. So it's a number of factors that have upset markets. It's not just the Ukrainian situation. And I think in the longer run, despite the human catastrophe that's obviously playing out, in the medium and the longer term for markets, it's about inflation, it's about interest rates. That's the main event really. And in terms of how you can adjust portfolios to cope with that, well, that's tricky. There's a number of things that have changed, but in a very short answer is the traditional 60-40 portfolio where you have 60 in equities and 40 in bonds is a little bit broken, likely, particularly that 40, because the outlook for fixed income is very poor. So having a broad range of alternatives in your portfolios from here has probably moved from a nice to have to a necessity.
Right. Yeah. Okay. And so rising inflation and then interest rates following, does that, in your opinion, impact the bond markets, corporate bonds, gilts, more than equities? Or
at the outset, yes. At the outset. So we've already seen bonds negative last year, right? And thinking this was coming. So gilts were down 5.5 last year. They're down again this year. The simple maths of a bond is if interest rates go up, the capital value comes down. And I think the bond market is currently factoring in about 5 interest rate rises in the States this year. We'll see the first one today, probably. We'll see the first one, we'll see another one in the UK later on this week. So that outlook for fixed income is poor. So we are very underweight fixed income. We still hold some because ultimately sovereign debt, be it UK or US, really, particularly US, is the ultimate safe haven. So if things turn really bad with the conflict, you still keep some protection from having that ultimate safe haven. But fixed income is going to be very negatively impacted by inflation. And you get to a certain point of inflation where it becomes difficult for other markets as well.
Right.
So if we see inflation at or above 5% for a protracted period, that becomes troublesome, because then you get wage increases. Some companies can't put through price increases, so their margins compress, and obviously if their margins compress, their value will drop as well. So I don't want to be too gloomy, but it's fair to say the investment landscape we're going into is likely very different to the one we've come from, and it does require a more nimble and a more thoughtful portfolio.
Yeah. Okay. So you just alluded to their sort of inflation impacting different companies in different ways. Is that a short-term pain? I mean, long-term, does inflation help in the long run?
Yeah, I mean, in the long run, all these things are, if you look at the sort of 5-year forward expectations for inflation, it has it coming back to a more reasonable level of sort of 2.5 and things like that. So in the long run, it's kind of fine. It's just these pockets of turbulence that you have to go through in markets, and sometimes they can be a little bit more protracted. But I guess it just points to picking the right companies that would have pricing power. I guess the discretionary spend is less attractive. If more of the household wealth is taken up on heating bills and putting petrol in the car and things like that, then those at the discretionary end of the market are likely to suffer to some degree.
Yeah, sure. So with that in mind, do you have the ability to skew the portfolio in a certain direction?
Yeah. So the majority of our equity component is directly invested. We don't do it through third-party funds. We do it through our investment. I'm looking over there because they sit over there. We do it through our investment team, at the desk, and we're able to be more nimble with that. And in times of stress, I remember it from 2020. It does come as comfort when prices are all over the place and moving around. You feel far more comfortable having a deep knowledge of the company that you own, that whatever the moves, the negative moves, they're likely to be temporary because the company is built on, solid foundations.
Okay. Yeah. Great. Okay. So thinking ahead, then obviously the various portfolios that clients will be in have a different target for inflation plus, bearing in mind the level of risk that we're taking and so on. Inflation rising, should that mean that we expect investment returns to rise over the long run as well if it's inflation plus?
Yeah.
Do you see anything upsetting that, or do we?
No, we don't. So we set these we set our inflation plus targets. We first started doing it 10 years ago, and then we reviewed those targets 5 years ago, and at that time we brought them down. Because then we were seeing, this fall off in interest rates. What you could get from fixed income and cash was very low. So it seemed appropriate to think, actually, it's going to get a lot harder going forward. We need to bring those down, which we did. And we just reviewed them again. We reviewed them at the back end of last year. And I guess the breaking news is that we're not going to bring those targets down. We're going to stick with CPI plus whatever it might be, 2.5, 3.5. But we do warn that it's getting more difficult. But we still feel over the long run, those objectives are appropriate and achievable. But I always say to clients when we see them, we often show them a line of their portfolio versus the CPI plus line. It can be above sometimes and it can be below sometimes. We say, look, don't get too excited when it's above and don't get too down when it's below. Over the longer run, that CPI plus line is the target objective, and it is achievable, and it remains achievable.
Yeah, Yeah, that's similar to, I sometimes use those exact words pretty much.
Yeah. Management of expectations, right?
Yeah, absolutely. Yeah, yeah. I mean, it's just the reality of being invested, isn't it? And those fluctuations in value of the price we pay for 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 the returns in the long run, ultimately, because the
Exactly.
alternative is leave everything in
Yeah.
cash. You just get a flat line, don't you? So there we go. Well, that's really useful, John. Is there anything else that's happening at the moment that ought to be on our minds? Anything?
No, I mean, there's any number of things. I mean, funnily enough, we were getting more defensive, a little bit more defensive. We're neutral to equities now. We've come from slightly overweight. We were getting more defensive around Omicron. That, you know, no one's talking about COVID anymore.
Yeah.
But it's still there. We mustn't forget that's still there. And bizarrely enough, the impact that's having is, I mean, it's ripping through our office at the moment. But I think in the UK, we're learning to live with it, which is probably the right thing. And touch wood that we continue that. But if you look in the Far East and China, for example, China is still, you know, pursuing this zero tolerance policy, which means they first sign of it, they lock things down, and that is creating tensions within supply chains, which creates bottlenecks, which is also inflationary. So I guess that's something else to keep an eye on as well. You know, everything is, I'm afraid, is pointing towards inflation at the moment, and it's just how we handle that. But I suppose on the plus side, you know, inflation will help people inflate their debts away, both, you know, governments and corporates and individuals. So it's not all bad.
Yes, I guess the challenge is, though, with that, you know, you think personal debt levels around, well, just think for the last 10, 15 years, there's a whole generation of people that have only ever known very, very low interest rates on mortgages. So the Bank of England have got an incredible challenge at raising rates, but
exactly, affordability of mortgages becomes a thing again, right? It's you know, mortgages have been incredibly affordable, but people haven't been able to afford the deposits to get on the, you know, and you know, now those mortgages will become less affordable as well. So I don't know about the long-term impact on housing from that.
So does the UK or the Bank of England tend to follow the Fed in rate rises?
It tends to, you know, where the US goes, the others tend to follow. You know, in fact, the UK was sort of have been a little bit earlier on this, but there is a feeling that we're probably all a little bit behind the curve, and rates need to move. And it really is a very fine tightrope to walk, you know, between managing inflation without choking off growth. And there's a hell of a lot of room for policy error. And I think the feeling in markets at the moment is that they're behind the curve, and we need to catch up by getting rates up a little bit. But that will be the main focus of attention. All things being equal, moving forward, you know, touch wood, we get some sort of resolution to this conflict in the not too distant future.
Okay, that's really great, John. Thank you. I got
good.
No other burning questions at this moment in time, but I send this out to all of my clients. If any questions come back, then I'll pass them on, and maybe we'll have another video in due course. But thank you for your time today.
No problem. Very happy. Thanks very much.
Bye.
Cheers, Steve.
Right.